Hi, everyone. I'm Ryan Thomas. I am Ryan Thomas, and I work for Saavi. I work independently as a financial advisor. And then here at Saavi, I am the controller, which is a specific kind of accountant. So I work in our finance department, and I look through our financial statements, work with the executive team, looking over things like our expenditures and our revenues, and seeing how we can do long range planning on that. So today I'm going to talk a little bit about personal financial management. And I just want to say, some of these things that we're talking about might seem like recommendations. I just want to make it clear if anyone actually acts on them, Saavi has no liability in that. You are taking this information and using it on your own. Saavi is not in the way of a financial advising company at all. This is just a way to better inform yourself as to what's available out there in terms of managing your own finances. So I really like talking about finance. I know a lot of people don't. I think they think it's boring or whatever, but managing our money shows us exactly what we value. We have a dependency relationship on it in that it covers our food and our shelter, our needs, things like that. But I think it's also really important to recognize that if we spend it on flashy cars, it shows that maybe we're a little bit more material. If we use it to donate to places like Saavi, it shows that we really care about Saavi's mission in training blind people to live independent lives and giving them those resources. So first of all, I want to talk about checking accounts. Checking accounts are really great because they're how we move money into and out of our lives really easily. We can have our employer auto deposit, which most people do, and then they're typically the account that most people pay their bills out of as well. So one thing that's really important for blind people, especially when they set up their checking accounts, is to make sure that it's an accessible one. So when I was looking, this was over 10 years ago, Wells Fargo had put a lot of effort into making things accessible. And they had Braille on their ATMs, they had screen reading software on their ATMs as well. So they were really sort of in the forefront of accessibility, which is why I ended up banking with them primarily. I can tell you I've had a number of accounts with other large banks before. Synchrony is one where I have my savings account. Chase is a good one. Capital One and Citibank I've had credit cards with. All of those seem to be accessible as well. I think that's become more of an industry standard now than it has been in the past. So like I was mentioning about our dependency, we have needs, which are things like food, shelter, clothing, etc. And those are things that we have to spend money on. It's important to differentiate those from our wants. Wants might be things like a really nice car, or it might be stereo equipment. It might not be something that you have to survive, but it's something that you want. And one really important aspect of managing our money is deciding how many wants we can afford at one time and managing how much we spend on those versus our needs. So one really helpful tool in managing needs versus wants is a budget. There are some online budgeting websites that can help you. And that's just a good planning tool to use so that you're not overspending. You can actually track how much money do I have coming in and how much of that am I going to allocate to each of the things that I need in my life. So I would put a certain amount to food, I would put a certain amount to clothing, I would put some to entertainment, I would put some to my shelter, I would put some to savings, and you're going to want to allocate all of what you bring in into some sort of category, and you can absolutely make categories like entertainment, things that you would spend money on that you don't necessarily need, but you should earmark all of the money that's coming in so that you know where it's going to end up. And budgeting is really important because you want to know when you get a paycheck, like I get paychecks twice a month. I want to know that if I have money coming in on the 15th, that I'll be able to pay for something on the 28th when my next paycheck is not going to come until the 31st. I want to know that I'm taken care of, that I have enough money to make it through from one paycheck to another. And some people have never done a budget before. So they're a good tool to figure out where your money's going. So if you look back at your previous bills and you actually make a spreadsheet or something like that, you'll figure out where your money has gone in the past and where you think it will need to go in the future. And there are two ways that you can manage your budget. You can make more money or you can cut your expenses. And a lot of us have a lot more control over our expenses than we do over how much we bring in. So it's really important to focus on your expenses and seeing, can I make any cuts? What will that look like, etc. So I'm going to talk a little bit about your FICO score. That's one thing that you hear commonly. FICO, F-I-C-O, stands for the Fair Isaac Corporation. And they came up with a number that indicates to lenders how safe you are as a borrower. So that number ranges from 250 to 900. And that score has different proportions. So for example, 35% of your FICO score is made up of your payment history. And so when they're computing that number, how regularly you pay your bills on time is the biggest portion of what makes that number. Another 30% are amounts that you owe. So they're going to look at your credit cards and how much you've spent versus your credit limit on all of those credit cards combined. They might also look at other loans that you've taken out, and they're going to look at the balance of that loan divided by the loan amount itself, how much you've ended up paying down since you borrowed it. That's going to be 30% of your FICO score. 15% is length of credit history, and that's how long you've had credit accounts of some sort, how long you've had loans, how long you've had credit cards, something like that. That's going to make it 15%. 10% is new credit opened. And so they're going to be looking at, have you opened a lot of credit recently? Because that makes you look risky. You know, they're not going to want to lend to someone who's opening a bunch of new credit, because that indicates to lenders that you might not be able to pay it back in future. And the last 10% in your FICO score is going to be types of credit. Lenders like to see that you're able to manage a bunch of different kinds. So that's going to involve credit card debt, that's going to involve car loans, mortgages, student loans, anything like that. They're going to want to see that you are able to manage a bunch of different types. And so how well you manage those is going to end up being 10% of your FICO score. And so again, that number is very common. You can check it on a lot of your credit cards. They offer a FICO score, and then you can actually look at what sorts of things impact that negatively or positively and adjust your behavior to maximize that. Because the higher your FICO score, the better off you are when you actually go to borrow a loan. You're going to end up with better interest rates. You're going to be able to get credit cards that have lower interest rates on them, or more points, or wider availability of use, things like that. Any questions so far?
I have actually a question myself, and I do have a question, but what's the total, what's the highest score someone can get?
900 is the very top score.
Okay. And then
740 and above are seen as really good. And typically when you get more than 740, that's when you get the best interest rates.
Perfect. Thank you. You might have already said this already or not, but Jordan asked, do you have any favorite apps or websites that you use for budgeting? Do you have any of those linked to your bank and create categories automatically?
When I budget, I typically just have a spreadsheet. You can just do it in Excel. Um, then of course you can Google, any sort of online budgeting websites that you want. Some financial advisors recommend spending only cash. Typically when you spend cash, you end up spending less than when you use something like a credit card. And so I know one financial advisor had a system where they put cash in envelopes, or in jars, something like that. And then when you're done with the money in the envelope or the jar, then you're done spending in that category. But I don't have any online one that I use or that are linked to my bank accounts. All right, anything else?
No, that's it. Thank you.
Okay. So another good thing to do is check your credit report every year. So you can do that for free on annualcreditreport.com. There are some other websites that you can use like Credit Sesame or Credit Karma, maybe you've heard of. And then also, there are 3 major credit reporting bureaus that track information about you and how well you manage things like debt. Those are Experian, TransUnion, and Equifax. Maybe you heard a few years ago, Equifax was involved in an enormous data breach. Something like 140 million Americans had their data stolen from Equifax. And as a portion of their settlement, you're able to go to the Equifax website and pull your credit report from that agency 6 times a year through 2026. Again, you can get it free once a year from annualcreditreport.com, but from Equifax, you can get it up to 6 times, which is a really useful tool. So credit reports are going to show all of the different loans you have. They're going to show your credit cards on them, things like that. And so they're a really good way for you to look at how you're doing from a credit standpoint. Do you have a lot of credit cards open? Things like that. There are very few ways to fix your credit quickly. If you have a low FICO score and you're trying to get that up, it really just takes some time. There are a lot of places that talk about credit consolidation or things like that. Those places aren't really able to do anything that you couldn't do personally. One of the first things they're going to do is go to your credit report and they're going to look through it. And mistakes on your credit report are more common than you might think. And so you're going to want to look for accounts that seem unfamiliar. Maybe that belongs to another Ryan Thomas or something like that. My name is very common, so it's possible that they put it on my credit report rather than someone else's. You're also going to want to look at your credit report because there might be accounts on there that are in your name that belong to someone else. Someone may have stolen your identity, opened a credit card in your name, and they might be using it, but you're going to sort of bear the responsibility for that in that it's under your name. And so looking at these on a regular basis is going to allow you to catch that, to stop it, to close that credit card down, and then to do anything that you have to make sure that that's not going to impact you in the long run. So let's talk a little bit about credit cards, because a lot of us use those nowadays. It's very easy to use cards rather than cash. But credit cards are one of the easiest ways to get into financial trouble quickly. They typically have very high interest rates. And so things that you're going to want to pay attention to are, what is my interest rate on a credit card? And am I able to pay the balance on my card off every month? Because otherwise I'm going to be hit with those fees. You're also going to want to look at your credit limit and how much you've spent in relation to your credit limit. So we talked a little bit about how the proportion of the amount of credit you've used over your credit limit is a big factor in your FICO score. But also you're going to want to make sure that you don't charge over your credit limit, because that can open you up to potential bank fees. Remember too that part of your FICO score is the length of credit history. So for young people, I got my first credit card at 18. And that was really good for me because now as an adult, I have a longer credit history than someone who went and got one at 20. So if you think that you can be really responsible with a credit card, it might be worth it to get one, even if you're not using it, just so that you start your credit history earlier. And another thing that you can do is become an authorized user on one of your parents' cards. I did that for a while as well. That gives you a longer credit history with some agencies like TransUnion, but some places don't count that. They only count those that are explicitly in your name. And so that's something to think about. But if you don't have the self-control and you think that you're going to spend, just the moment you get a credit card, maybe it's not worth getting one, because again, it's really easy to get into trouble with credit cards. All right, any questions on credit reports or credit cards?
No, we're good.
Okay. Saving for college is one of those large expenses that a lot of parents are thinking about, especially for their kids. I didn't write a lot about this, but there are some things that can save you a little bit of money when you're doing that sort of planning. There are savings bonds, and some of them have some benefits. So for example, when you redeem Series EE or Series I savings bonds, qualifying savings bonds, you're able to deduct the interest that you spend on redeeming those from your gross income when you do your taxes, if you end up spending the money from those on qualifying educational expenses. So those might be worth looking into, Series EE and Series I savings bonds. Also, there are things called 529 plans. Those are tax advantage savings plans that often parents will open for their children. So you can put in some money there, that money can grow, you can pull that out with some tax advantages, as long as you spend that on education. And so that's often a nice vehicle that people have access to when they're thinking about saving for college for themselves or their children. So retirement is also one of those long-range planning things that we talk about a lot. Work-sponsored retirement accounts are often in the form of 403Bs if you work for a nonprofit, or 401Ks, which are common among corporations and businesses. One of the really great things about work-sponsored plans is that a lot of places offer a match. And so if you put in a certain amount of your income to those accounts, your work is going to end up matching the funds that you put in there. So for Saavi, for example, they match 3% of what I put into my 401k. So if I put in 3% of what I make, they put in the exact same amount. And that's really huge because when you think about investments, that's a 100% return on my money. 100% is much, much higher than anything I would get in the stock market. It's way higher than anything that I get from a savings account. It's even higher than interest rates that I would pay if I had credit cards. So one of the best things that people can do personally is if your employer has a match, opening an account with them and putting contributions up to the point of the match ends up being really beneficial for people financially. And then outside of work, there are things like individual retirement accounts, IRAs, and those are a good savings vehicle as well. There are two main types. Traditional IRAs let me put pre-tax dollars in now. That means I make contributions to those traditional IRAs and I'm able to deduct that from the taxes in the year that I contribute. Roth IRAs are a little bit different. Roths, I put in post-tax dollars. That means after I've paid taxes on them. And then anything that I put in can grow in that account because I'm investing it. And then in retirement, when I take those savings out, I don't pay taxes at that time. A traditional account, I don't pay taxes now and I end up paying them later. Roths, I pay taxes now and I do not pay them later. And so typically Roths are more beneficial for young people because any growth that you see on that account, you will not pay taxes on later on when you pull that out in retirement. All right, now I want to talk just a little bit about insurance. Health insurance, most of us have it, most of us need it because healthcare is so expensive. And again, because healthcare can be so expensive, it's really important that most people maintain some sort of safety net. Life insurance then is one that's really interesting because the amount that you cover yourself for life insurance is highly variable. So I keep a very low life insurance policy on myself because I don't have dependents. I keep enough that it could pay for my funeral or something like that. But in general, were I to die, people aren't depending on me to be able to make their bills. If someone does have dependents, they would probably want to have a greater life insurance coverage. You know, things that you might want to consider are my children depending on the income that I bring in? Is my spouse depending on that income? How many years could they make it if they got my life insurance policy paid out? Things like that. Those are what you're going to want to compute in your head when you think about the amount of coverage that you want when you're figuring out your life insurance. And then, you know, as your children age, as they get jobs of their own, as they're no longer dependent on you, you know, might want to decrease your amount of coverage because that decreases the premiums that you're paying. Also, home insurance. A lot of policies when you're looking at home insurance are going to insure you up to the purchase price of your house, which is great. But if something happens to your house and you have to replace it, you know, if my house is $200,000, it gets destroyed, they're going to give me 200,000, but if I need to replace that house and costs have gone up, and now to build something on top of it to replace my home, I now have $250,000, then I'm going to be in trouble. And so when you're looking at your policy, it's really important to see, are there adjustments as time goes on? If costs go up, are they going to increase the amount of payouts so that I can replace my home, or are they just going to end up giving me the purchase price? Those are some things that you're going to want to consider with regards to home insurance. And you're also going to want to consider, do they cover flood damage? Do they cover fire damage? Do they cover earthquake? Are these things that I'm going to be able to depend on from my current policy, or do I need to look for other policies, especially if I live in a floodplain or in a fire-prone area? Are they going to cover stolen goods? When I was young in college, my mother's house was broken into and they stole our television, all of our electronics, our televisions, our computers, my brother's guitar amp. They stole a lot of things from my room, including some musical instruments. And that was really difficult. And, our policy covered stolen goods. So we were able to report that, and they were able to give us a check for some of those. And that made it, a more survivable experience. But those are some of the things that you'll want to look for when you're actually picking insurance coverage, how much it costs, what specifically they cover. Really look through those policy documents. Anything on some of those long-term savings goals like college or retirement or insurance that you want to ask?
Ryan, we have a question.
Yes.
So, Michael Gordon said, how can someone improve and establish a good credit score if it has always been low in the past?
So again, the biggest thing that goes into that is payment history. So you're going to want to make sure that going forward, you always make all of your payments. Some people feel like when they get into financial distress, they will skip things, especially on their credit cards. They don't make the minimum payment. You have to make the minimum payment every time. Payment history is going to be the biggest thing. Again, maybe it's low because there are mistakes on your credit reports. And so you want to pull that, and then you want to look through, are there mistakes? If there are, you want to report that to the credit rating agencies, because they can remove that, and that might have an instantaneous effect on your credit score. Like I said, for young people, they might want to become an authorized user on a credit card that's been established for a long time. Or you might want to open a credit card right now so that you have a longer credit history if you've never had one before. So there are a number of different things that you can try. But again, time is the most critical factor in gaining a good credit score. Any other questions?
No, that's it. Thank you very much.
Going to touch a little bit on investing. One of my financial instructors would say that short-term investing isn't investing at all. It's just gambling. Typically, people are afraid to enter the stock market because they're afraid of its volatility. And it's true, things go up and down in the stock market all the time. But over time, your risk decreases. If you're invested for a long period of time, generally we see a positive trend in the stock market. And so for people who are willing to put money in and are willing to stay in, then it typically ends up being positive. That's over the entire market. There are certain companies that may or may not survive long term. That's going to be a little bit different. But Generally, if you're able to enter the market, if you're able to have a diverse portfolio of a bunch of different things in the market, then it's positive over time.
I
As
have
I mentioned,
another question here.
yeah,
Sorry. Same person, Michael Gordon said, can you explain what happens to a 401k for young people if they change jobs? Also, is that money ever available before retirement?
yes. So if I were to leave my job at Saavi and start with a new company, then I would have a 401k with that company. I could always take the 401k savings that I had here at Saavi and roll that over into my new account. And that's probably a good idea because then it leaves me with fewer accounts to manage. You may not want to do that if your new employer has fewer investment opportunities. I maintain my thrift savings plan from when I worked with the government because I specifically like the investment options that it had. I have not rolled that over, but that is an option to me. So you can keep rolling that over to each new job if you want to. You can maintain the account separately. It all depends on sort of whether you like the investment opportunities that are open in your current 401k plan or not. You can take money out of a 401k, but if you're young, then it comes with penalties, it comes with taxes, and you end up getting very little of what you pulled out. And so typically, if you're able to, you want to leave it in your retirement accounts longer because otherwise you're going to be hit with all of these additional fees and penalties and taxes that you wouldn't have otherwise. There are some exceptions. You can take a 401k loan out for the purchase of a primary residence, and there are rules behind paying it back and when you have to do that and whether there are penalties, etc. So that's something worth looking into if you're considering a 401k loan of some sort. All right, so going back to investing, you can invest in single companies. Like if I want to go buy shares of Apple in the stock market, a share is a portion of that business. And I'm either going to see my stock, my share, go up or down in price. And if I sell that, if the share price has gone up and I sell it at that higher price, then I've made a capital gain. I've made some money on that because the business is doing well and I'm taking part in their success. Another way that businesses share their success is by paying out dividends. And so that's where they actually give you cash just because you are a partial owner and they're paying out some of that success to the people who own the company. Finance and especially investing have a whole language of its own and it's sometimes very difficult to learn all of the different aspects of the terminology. When you are buying shares, you can buy at market, or you can put a limit order in, or you can add trailing stop loss. There are a bunch of different things that can be very complicated when you're getting into investing. So either you can do research and learn all of those terms on your own, or you can look for like a robo-advisor. That's a number of companies manage your money automatically using computers. That's a robo-advisor. They are going to invest for you. And so you just move some money into their account. They invest it. It's all done sort of automatically. It rebalances your portfolio so that you maintain a specific level of risk. It's a very simple thing. You can also find professional financial advisors. And that's kind of nice. I like working with people better because, you can ask them questions, you can learn more about investments, you can ask their advice on things, you can just gain a better understanding of what it is to manage your money, to invest it well. If they're an accountant of some sort with tax experience, they might be able to help you save money on your taxes. And so that's more money that you can invest or save or put in retirement. Those are all some of the benefits of working with an actual individual. All right, the last thing I wanted to talk about are ABLE accounts. This is really important, especially for people with disabilities. ABLE is achieving better life experience. And in 2014, there was an act that went through specifically related to people with disabilities and this savings account. A lot of public benefits that some disabled people use, like SSI, Social Security Income, or SSDI, which is disability, SNAP, supplemental nutrition assistance, housing assistance through HUD, things like that typically mandate that you don't have assets in your name or have very little, like only $2,000. And so that leaves a person very dependent on a continuous stream of government assistance. And that can be really difficult for people, especially because living with disabilities frequently come with additional costs. You might have to spend a lot of money on assistive technology, which can be very pricey. Or maybe you have medications that you have to take that are expensive. Maybe you need to improve your house by adding a ramp so that it's more usable to you. Or maybe you want to put handrails in your bathroom so that it's safer to get into and out of the bathtub or shower. All of those sorts of things are additional costs that impact people with disabilities. And when you have this mandate that you have to have very few assets, it's sometimes very hard to afford those things. And so they created ABLE accounts to address some of those needs. People who are able to create ABLE accounts are those that have had age of disability onset before 26. So that means you can be any age right now, but you have to have become disabled before your 26th birthday. And if you had onset of disability before 26 and you're receiving SSI or SSDI benefits, you're automatically able to make one of those accounts right now. If you're not a recipient of SSI or SSDI, you can still create those accounts as long as you became disabled before 26, but you might have to submit medical documentation or and as long as you meet the SSI definition of a significant limitation. There is a bill in Congress that would adjust the age of disability onset up to 46. So that's legislatively in the works. And you can track that if you want. But one really nice thing about ABLE accounts is that the first $100,000 in the account is not going to be seen as an asset when they're looking at your SSI or SSDI benefits. And so where it was the case that you could only have $2,000, now you can have $100,000 in an ABLE account that does not count against you when you're applying for other benefits. And then if you are employed, well, you can contribute up to $15,000 to an ABLE account every year. And anyone can contribute for you. Friends, relatives, you yourself, anyone can put money in that ABLE account for you. And then if you do not also contribute to, if you do not have an employer-sponsored retirement plan, then you're able to add an additional amount up to the individual poverty level, which is in 2020, $12,490 in the continental United States. Hawaii is a little bit higher, and then Alaska is even higher than that. That's an additional amount that you can contribute to your ABLE account over the $15,000, provided you don't have an employer-sponsored retirement account. And then you can take that money and spend it on qualifying disability expenses. That can include education, food, housing, transportation. It might include the technology I mentioned earlier. It might include, adapting your house, or the costs of transcribing a book, which I can tell you from personal experience are very expensive. Any of those things can come out of an ABLE account. You can only have one per person. And the ABLE accounts are run state by state, and some have tax benefits. So if you're from Ohio and you contribute to your Ohio plan, then you're able to deduct the contributions from your state income tax. That might be the case, so you should look into your own state's plans. Arizona does have a plan, but it doesn't have any tax benefits at the moment. That can change legislatively. I'd really like to see it do so. Maybe that's a goal for the future, but when I opened one, I opened a plan through Massachusetts, because some allow people out of state to enroll in their program. And the reason I chose Massachusetts is because I didn't have to put any money in initially. So if I needed to, I could open that account and then let it sit there. And then rather than paying fees out of what I had in there at the moment, it took fees over time from my investments. And that was just what I needed at the moment. So you can look at all of those different things. They all have different requirements, different fees associated with them, et cetera. And that's how you can make your decision as to what ABLE account would be good. And then one thing that's really nice is the funds in there are invested, and you can choose a level of risk that you want. Mine is pretty aggressive right now because I have a job, I'm well employed, I meet all of my bills with my salary, so I have it invested a little bit more aggressively, which means that I can probably expect a little bit higher growth over time. But were I to lose my job, I might make it a little bit more conservative. I would make a little bit less money, but I know that that money is going to be there over time as I require it to pay for my housing and food and those other things. You can only change investment strategy twice a year though, so that's something to consider. And these are a really nice savings vehicle for people with disabilities because they're cheaper to set up than a special needs trust, which is another thing that people can set up when they're looking at caring for people with disabilities. So that's ABLE accounts. There are some great references out there too to look at if you're interested in making an ABLE account, or if you're interested in a family member doing so. Are there any questions on any of that?
No, but thank you for it.
Sounds good. That's my presentation. So thank you very much for watching. I hope that maybe some of this information told you something that you didn't know, or made you interested in looking for more resources on your own. but I appreciate you listening.
How does someone contact you if they have any questions?
That's a great question. They can email my Saavi address if they'd like, which is rthomas, rthomas, at saavi.us. I can answer some questions there.
Thank you very much. All right, I'm gonna end it here shortly for you, Ryan.